India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to a brand new week and a brand new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me as always is Nigel D'Souza. And today we have Rima with us to kickstart a week. I think last week was a hectic one. It was a heavy one.
Indeed.
Major events out of the way, and I think it's going to be very interesting, the direction and the route that our markets take. Morning, guys.
Hi, good morning. And it's a truncated week, guys.
And it's the end of earnings season as well.
It's the end of the earnings season.
And it's been quite an earnings season with a lot of disappointments. Yeah. After a while, we've seen this sort of an earnings season. But let's hope things shape up well from a bullish perspective as the week progresses.
Yeah, absolutely. I guess the bulls will be happy. I think I call it the week after. Like you have the morning after, now this is the week after. You've had a lot of these heavy headlines and events. So if the bulls can manage to even continue in consolidation without cracking once again,
Indeed.
I think that would be something that people will take on board. So let's get started and let's take a look at how the setup is poised this morning. What we have is, once again, a very positive handover from Wall Street. So the Trump trade is still very much raging on. Whether you're looking at US equities or you're looking at the crypto markets, by the way, new headlines there literally on the hour on crypto. What happened on Friday was that we had all the key indices, the Dow, the S&P 500, NASDAQ, and the Russell 2000. They kept on notching more gains. The Russell once again was outperforming because that's been the biggest talking point, right? That how the next leg of the US rally is now going to be in the mid and small caps. And we've seen more evidence of that play out. So good handover coming in from Wall Street. Let's talk about what's been happening with yields and the dollar. Yeah, that's the picture. And we'll talk more about this as we go forward. The last huge big week that we had, the US markets put in anywhere between 5 to 9% gains. We managed to stay flat throughout it. So that's important context to keep in mind. We'll talk about it as we go forward. On the yields and on the dollar, yields cooled off quite a bit after that high drama midweek of 4.4% on the US 10-year. Now you're back to a more reasonable 4.3%. The dollar also has retreated a little bit, but it's not too far away from the recent highs, still very much around that 105 handle. So, now that we have the big central bank moves also done, BOE has cut, Fed has cut, and it's going to be more eyes on China. Speaking of China, the markets around our neighborhood are a little subdued today. In particular, China, it's very, very clear that this NPC disappointment is still playing out this morning as well. This $1.4 trillion or 10 trillion yuan package is not really lighting up the street. There is the Singles Day shopping event that's starting off. So I think that's going to be very important to track from just a retail demand perspective. And ahead of that, there's some red on Chinese markets this morning. For us, just to quickly complete the picture, the consolidation band, like we just contrasted our performance with Wall Street, where indices are up almost 5, 6, 7%. The Nifty has been range bound, and the bulls will hope that more consolidation is better than a fall. So the range of the consolidation between the lows and the high, we're talking about 23,800, 816 to be more precise. On the downside of the range, the upside of the range has been capped at 24,500. So net, we're talking about a 700-point trading range. As long as the downside doesn't break, I think the bulls will take that. Breaking it through the upside, of course, is something that we'll keep in mind. Lots of earnings to go over, and Rima and Nigel will talk more about that. It's a mixed bag as usual. Asian Paints was weak, Tata Motors was weak, but the company is sounding very, very optimistic. Ola's losses are reducing. So, and Divi's, some of the pharma numbers have been looking very, very good. So we'll keep going through the individual stock action. But at the headline level, I suppose it's very important for us not to break below last week's lows. So I'm going to watch out for the lows quite carefully this morning, Rima.
Indeed. The problem for our market is, on one hand, you've got earnings, not just misses, in some cases, howlers. Like Asian Paints, for instance, right? It's a broad-based, miss, right? From revenues to margins. And it's missed expectations by a very wide margin. Volumes have declined by 0.5%. And this is the first volume decline that we've seen since COVID. And there have been so many such instances. So Jefferies, I think there's a recent note where they say out of 121 companies that they cover, 63% of them have reported in their coverage, 63% have seen earnings downgrades. So that is one problem pocket for our market. Now, the question is whether the expected recovery in the second half plays out. And the second one is this consistent, persistent, massive FI selling. Last week, every single day, the FI sold and accumulating to nearly 19,500 crore. That was the extent of the FI selling last week. The DIIs were buyers. They bought about 15,000 crore as of last week. What will you watch today? As we said, it's a truncated week. Friday is a holiday on account of Guru Nanak Jayanti. So we've got 4 days of trade lined up over here. Today, big earnings from ONGC, Britannia, Hindalco, Shree Cement. Later on in this week, in the economic calendar for India, we also have the CPI print that will come out tomorrow, and US inflation print on Wednesday, and the retail sales on Friday. So now that the big, events are out of the way, the economic calendar is what
we go
folks
back
in
to
the US
following
will be
data,
going back.
Well, that's right. Just to build on to what you all said, the earnings season has definitely been a disappointment. Far more misses than hits. And in fact, there's been a scale down in the EPS estimates as well. But how much of this earnings disappointment is in the price with around an 8% correction on the Nifty? Well, we'll come to know about that. And also Asian Paints and Tata Motors, both of those numbers are very, very disappointing. But both the managements are guiding for a far better second half of the year. So will the street look to buy into this sort of a dip? The numbers are disappointing. So let's see how that plays out as well. The second factor is the Chinese stimulus was touted about. Everyone was talking about it, right? And that shift, the hot money that will move out of India into China. Now, the stimulus isn't as great. So will this FI selling slow down a little bit? For the last many sessions, there have been sellers. Can we see the quantum reduce? That will be a bit of a relief from a bullish perspective. So I'll keep an eye out on both those 2 points, earnings and the FI selling in the cash market. In the F&O market, they continue to add shorts. They added close to around 4,000 short contracts. And now the short positioning continues to hold above that 75% odd mark. You need some kind of good news to get these FI stumped. For the time being, they've been getting it right, actually, because they are holding on to those short positions. And the markets, in fact, have seen more or less a time-wise correction in the last few sessions or so. Now, in Friday's trading session, yes, the Nifty ended low, but you had the VIX as well that did cool off in trade. And sometimes, that's the sign that maybe in the near term, you could see a bit of a bounce. I'll be clutching onto this data point as well. Moving to the options data, then we had 2 strikes that were very active. 24,200 call, fairly active, 14 lakh shares out there. And on the downside, the 24,100 put was active. The premium on both of them around 120 rupees. Plugging in this premium and the options data, we get the support and the resistance for the day. So this is just for the day, 23,950, and resistance comes in at around 24,350. That's the range for the day. But the bulls are counting on this level holding out, the 23,800. We almost visited that twice last week. So the bulls believe that this level at least can hold out. And HDFC Bank, we've been making this point. It has been a bit of an underperformer in the last 18 to 24 months. But even in Friday's trading session, that held one end up. That was up close to around 0.5% or thereabouts. Until it holds on to this 1,690 level, 1,700 odd level, you'll say that you'll have to back this one to fight for the bulls. And the Nifty Bank will be important because HDFC Bank, well, that's holding one end up. But the Nifty Bank, well, in Friday's trading session, it ended down close to around 0.7%. Now it has both the resistance zones up ahead of it, the 20 and the 50 DMA. So HDFC Bank can hold on to gains and hold more or less the flattish line and consolidate for a bit. The Nifty Bank, if it can fight back, it can get past those technical levels, which will give the bulls some ammunition to get closer to around the 24,500 odd mark. The gift Nifty suggesting 80-point downtick. I think at some point of time today, we see a bit of a recovery intraday.
Yeah, I guess we'll watch for that. And if indeed we can pick some green, because right now Asian screens are quite weak. By the way, Hong Kong market's down about 2.5%. Inflation numbers out of China are looking weak. The rise is, there's hardly a rise, 0.3% for the month gone by. So that's also in focus. Basically, China in 1 to 2.5%. That's the kind of decline that we're seeing in some of the China and the peripheral markets as well. Let's start the show then with the equity call of the morning. Mahesh Nadurkar of Jefferies says more than a fifth of stocks under Jefferies India coverage are trading below the June election results low, and 30% are down more than 20% from the 2024 peaks. He says a pickup in government spending, capex in the second half, improved seasonality, and somewhat better relative valuations mean that a potential short-term bounce back is possible in the market after the recent correction.
Okay, let's talk about the global economy. The big talking points are how will the Trump tariff trades be implemented? Will it be implemented at all? What is the response now to China's underwhelming stimulus package, which was announced? Who better than to invite Chetan Iyer, Chief Asia Economist in Emerging Markets at Morgan Stanley, to join us on the show. Mr. Iyer, thank you very much for joining in. So first, you tell us, how should we assess this entire tariff situation, which may not play out? How will it play out? By when? Give us your reading of it, and what will it mean for global economies? Because we're talking about potential tariff, a potential trade war, US cuts, maybe some deregulation.
Yeah, so I think from tariffs perspective, what we are currently operating with is an assumption that there may not be 10% tariff, universal tariffs coming in quickly, because that will require legislative changes. So we think in our base case, we should assume that US will probably impose tariffs only on China and take up some bilateral issues with other big trade partners like Europe and Mexico. And as far as China tariffs are concerned, it could be possible that they raise it gradually rather than going at one go. We are assuming that it could be 50 or 60% tariffs cumulatively in terms of whenever the increase is done in total. But it will be taken up in most likely in a gradual manner. So with that assumption, we think that the tariffs impact on the region could be much less than what we saw in 2018-19. So to just give you a backdrop, in 2018-19, growth impact was 1 percentage point for the whole region. China also saw 1 percentage point decline in its growth rate. But bulk of that negative impact came from global corporate confidence getting affected, global trade getting affected, rather than the direct effect of tariffs. And therefore, in this cycle, we think the impact could be much less, because now everybody is aware about the issues between US and China. Corporations have already taken up the effort to diversify. So we think that this time the downside could be more manageable than what we saw in 2018-19.
So to summarize, we may not see a uniform 10% tariff on all imports into China, into US, but on China, we will eventually get to 50-60% tariffs, but it will happen in a gradual manner. And the overall impact will be less.
That's right.
Chetan, hi, good morning. So I think markets are just trying to second guess exactly some of the scenarios that you laid out, right? Beyond tariffs, do you think this Trump sweep in the States, will it have any sort of bearing on the direction of interest rate policy as well? Because the Fed's moved. We heard that big statement from the Fed chief as well, saying no one can fire me. But in terms of rate differentials, and the US is going on cutting, Japan has been on pause, though, I mean, intrinsically, I think Japan was on the hiking path. What happens to interest rate differentials and policy, Asia vis-a-vis the US?
So, look, I think firstly, in the US's case, in the near term, apart from tariff policy, it is going to be difficult for the US to take up fiscal expansion immediately. Our US public policy teams that in terms of sequencing, it could be tariffs first, and then fiscal policy in 2026. So fiscal policy will take time. It will have to get through the approval from the Congress. And also the team has to sit back and work out the math in terms of how much tax cuts they can do and how much revenue or the pay for will come from different parts. So it's really tariffs, which is really at discussion. And that too, as I was mentioning earlier, if it is gradual, then the impact could be moderate. So at this point of time, I think in the next few meetings, the Fed continues to go implementing those rate cuts as we have built in. And so we are expecting, rate cuts to come through in the near term, as Fed was originally building in. So I think that is on track. And as far as Asia is concerned, we are expecting rate cuts to come through. But look, I think when tariffs come, there will potentially be more rate cuts priced in. And so interest rate differentials will still be in a way that Asian currencies will be under pressure if tariffs are taken up as an action.
Hi, Chetan. Good morning and good to see you, Ben. Nigel on this side. I want to come back home to India then. In this sort of a backdrop, what are you pricing in with regard to the RBI in terms of cuts? By when do we get our first cut and how many are you pricing in? And also your quick take on this perceived slowdown here in India. A couple of data points are soft, but the hope is second half of the year will look much better. Capex spending is likely to pick up. The October second half wasn't too bad as well. So what does the RBI do next? And please comment on how do you see things shape up with regard to the softish data?
So first up, we are expecting RBI to take up 2 rate cuts starting in from February. And then depending upon how big a damage to Asia's growth is from that tariffs eventually when they come up, we could see additional actions from RBI. As far as the current growth slowdown that is ongoing in India is concerned, we think that the biggest factor that has caused this growth slowdown is the government spending. When you look at government spending, center plus states taken together, it's 29% of GDP. And so that line item has been sort of relatively stalled. We don't have the state spending data more up to date. But as you saw, the central government spending data up to September, it's been still held back and has not seen that pickup that you usually see after general elections. And so we are expecting that to pick up in the coming months. If you just assume that the budget number will be achieved for capital expenditure, for example, you should see like a 50% increase in government's capital expenditure. Now, I understand that there is skepticism that they may not be able to achieve that target. But even if they don't achieve the target, it will still be somewhere in the range of 30-40% increase in government's capital expenditure in the second half. So we think that this major factor why we've seen that slowdown in India should be coming through in terms of support to recovery in the second half. And as far as consumption is concerned, I think the data that we got from auto companies was promising. And we are also hearing that, independently of that, even FMCG companies are saying that rural consumption is improving. So we think consumer spending should also begin to improve back again in second half. And government capex should lead that capex cycle in addition to that recovery in consumption. So we are still expecting that recovery to come back in second half of financial year.
Got it. So maybe the twin engines will fire up together in H2. That is government spending along with the pickup in consumption. Chetan, great to have that perspective. Thank you very much for joining us on the show today. You have a good day ahead and we look forward to another call soon. Thank you.
Thank you.
All right. Well, with that, let's quickly move on and tell you the lineup on the show today, the kind of companies and the experts that you will hear from. Coming up at 8:35, we'll be in conversation with Shenu Agrawal of Ashok Leyland to talk about the second quarter performance and whether the second half will be better for CV manufacturers. At 9 a.m., we'll have Dayananda Vaidya of Axis Securities talking about SBI's Q2 earnings and the banking sector outlook. At 9:20, we get chatting with our market master of the day, which is Gautam Trivedi of Nepean Capital. At 9:30, the management of Vedanta joins in to talk about the second quarter performance and the outlook. Then we have Rajiv Rajagopal of Axo Nobel chatting with us at around 9:40, talk about their plans for the business here in India. And at around 9:50, we will take up the second quarter performance at InfoEdge, which has been fairly strong. Chintan Thakkar will join in to talk about the outlook. Finally, towards the end of the show, in our special segment, it's the economy. Lata will be in conversation with Louis Quij of S&P Global Ratings and Hui Shan of Goldman Sachs to talk about the impact of the Trump victory on global markets and the latest Chinese stimulus package.
Well, time to slip into a short break, but we've got a lot of stock-specific action to track for you. We get to that in just a bit. For the time being, we run you through the list, looking at Divi's, LIC, Fortis Health, GE Vernova, TND. All of them will be reacting to positive news flow. We have more red in comparison to green today. Asian Paints, Tata Motors, Auto Pharma, Ola Electric, Aarti Industries, and Equitas SFB. All of them will be reacting to negative news flow. Slip into that break, come back. We'll focus in greater detail.
Okay, so the cue's a little somber this morning across our neighborhood. Lots of red on Asian markets, with Hong Kong leading the losses, actually, down about 2.5%. So therefore, the implied open is suggesting that we keep cooling off. Let's see if the actual market opening can buck this kind of weakness that we're seeing across Asia. Let's dial it down to stocks right now, and plenty of them to keep on the radar, some on the base of earnings and some on the back of other news flow. Our team is right here, so happy Monday to all of you guys. Vinny, let me start with you. Asian Paints, I think the color is red on this one, unless the market decides to be optimistic on the future. But tell us about the numbers.
So right now, yes, red for the numbers is what we were expecting. Nothing exciting coming in from Asian Paints. Domestic volume, look at it. It's seen a decline this time of 0.5%. Was the expectation was a volume growth of around 6 to 8%. Revenues, PAT, EBITDA, margins, all of them are below the CNBC TV 18 poll. While in terms of Q2 performance, just a breakdown for that, revenue has seen a decline of around 5.3%. EBITDA is down almost 28%, and margins have seen a contraction of 480 basis points on a year-on-year basis. So sharp contraction in terms of margins. What led to this weak performance when you look at it? Because of the consumer sentiment being weak, there were a lot of rains that we saw coming in during the quarter, as well as floods in some part of the country impacted the performance. Operating margins also impacted because of the higher raw material cost that was there and price increases on the raw material front, as well as increased sales expenses, and international business impacted because of the concerns in Bangladesh as well as Ethiopia, causing to some bit of a pressure even on the international side. Profits also impacted because there was a one-off this time, as well as a forex loss in Ethiopia. So yes, a coat of red is what we're expecting for Asian Paints. Even analysts are not too happy with the numbers.
Okay, all right, Vinny, thanks a lot for that. Just 1 point, in the last 1 month, the stock has lost 9%. So, the street is anticipating a weaker set of numbers. Sudarshan joins in, though, to tell us about how are Tata Motors' numbers. Sudarshan, a little bit disappointing, but they're guiding for better things.
Morning, Nigel. That's correct. So earnings were below estimates for Tata Motors. Muted CV demand impacted the earnings, while for JLR, production and shipment issues have weighed on the earnings. So first, talking about the numbers, consolidated Tata Motors revenue was down 4%, EBITDA has fallen 12%, and margin has come down by more than 100 basis points. Similarly, for JLR, revenue was down 6%, EBITDA margin has fallen more than 320 basis points, and even EBIT margin was down almost 100 basis points. So what but outlook by both JLR and Tata Motors were positive. JLR says volumes are expected to recover strongly in H2 FY25, and that's the reason it holds on to EBIT margin guidance of at least 8.5% or a little bit more than that. Tata Motors says it expects all-round improvement in H2 FY25 and also business to become net debt-free this year. So I'm going with mild red. Stock might open in the red, but may see a recovery intraday.
Thank you for that. Back to Winnie now for a pharma update. Winnie.
Yes, so we're keeping an eye out on two important stocks. One is Aurobindo Pharma as well as Divi's. This is on the back of their numbers. Aurobindo Pharma, not an exciting number coming in from the company. Revenue was in line, but we saw a miss coming in on the margins and profitability. Look at the revenue also, just a growth of around 8%. Margins, yes, seeing a bit of an improvement there, 20% versus 19%, but our poll was much higher in terms of expectation for the EBITDA margin at around 28%. So miss coming in on that front. Profits were a miss mainly because of the research development expenses spends were higher. OPEX spend was higher and taxes were higher, so that impacted the profitability of the company. US sales marginal decline came in on that front because of Revlimid, but the core business that has managed to do well. So yes, not a worry on that front. Core was fine. Just Revlimid sales expected to be a slightly bit lower, so keeping an eye on that. Europe, rest of the world saw a growth of around 19% and 44% respectively. API sales muted is what we could call it. So all in all, revenue was in line. Outlook seems like quite positive in terms of when you look at it for the future of the company. But other than that, Divi's Lab, a very strong set of numbers on the other hand that you're seeing from Divi's Lab. Double-digit revenue growth driven by increased demand for consumer synthesis, custom synthesis, as well as emerging generics that saw very good growth. Custom synthesis saw a high interest and engagement from innovators, leading to good growth and expectations also being better. Generic sales, that growth was driven by volumes amid the high pricing pressure that one saw coming in. So keeping an eye out on the generic side of the business, a bit of a pricing pressure there, but all in all, good numbers from Divi's, so green expected there.
Okay, yeah, Divi's did indeed turn out with quite a strong performance. Thank you for that, Vinny. Let's go back to Sudarshan. Ola Electric in focus, Sudarshan. Losses at least are narrowing.
So numbers mentioned in their press release after Q2 earnings do show some improvement on the operational front, but earnings overall were below estimates. So what all have impacted earnings? First, warranty provisions. Second, employee and marketing spends. And third, premium segment, which is the major contributor to their total revenue. Deliveries of premium segment were down both sequentially and year-on-year, but mass segment has seen a growth of 15%. Also, company has maintained market share of more than 30% in Q2 FY25. Now, talking about the numbers, net loss for Q2 has come in at ₹495 crore versus loss of ₹524 crore in the same quarter last year. Revenue was up 39% to ₹1,246 crore, and EBITDA loss, as per their release, has come down down to 223 crore versus loss of rupees 321 crore they have reported in the same quarter last year. So what do they say going forward? What are they are planning to see? First, they are saying that they are going to improve gross margin further from the level of 20.6% that they have reported this quarter. Also, they are going to launch overall 20 products over the next 2 years. That means one product every quarter, and they have announced launch of electric three-wheeler. Announced means they will be launching that electric three-wheeler in next fiscal, and they'll be using in-house sales in EV products starting Q1 FY26. But all eyes will be on company's commentary by when they are looking at the break-even level on EBITDA.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Yash. Yash, you gave us a heads up on LIC's numbers. Were they as good as you were expecting?
Well, Nigel, let's bring some cheer as far as the earnings front is concerned. Very strong numbers from LIC coming in the second quarter. They were ahead of the street estimates, all counts, and again, very strong growth on a year-on-year basis. Total AP, that grew by 26%. It was ahead of the street estimates by at least about 600 crore rupees. Total annualized premium equivalent, that again grew by 26%, coming in at about 16,465 crore rupees, ahead of the street estimates again. Retail AP, that grew by 31%, again beating the street estimates by at least about 1,400 crore rupees. Value of new business, that grew by a strong 47%, ahead of the street estimates by about 600 crore rupees, coming in at about 2941 crore rupees. Now, as I said, on Friday, all eyes will be on margins, and margins were bang on, coming in very strong at about 18% versus 15.29% on a year-on-year basis, and beating the street estimates by 350 basis points as well.
Okay, thank you very much for that. LIC, it was down for the last 2 days. Perhaps it will recover today. But Vinny's back with us for Fortis Healthcare. Vinny.
Fortis Healthcare, strong set of numbers, strong show coming in Q2 FY25. So expecting a green today. Revenue growth of around 14%. This was led by good growth that one saw in the hospital side, which saw 14% growth. Margins quite healthy, right? Look at the margins, 21%, 21.8% versus 18.6%. So healthy margins were led in both the hospitals as well as the Agilus business, which was aided by seasonality for Fortis Healthcare. Healthy occupancy is 72% versus 69%. Hotel margins, hospital margins, I beg your pardon, have also improved consistently due to increasing occupancies. And Agilus, the management is saying that they're eyeing double-digit revenue growth and 25% margins over there. So good show and good performance coming in from Fortis Healthcare. Green expected for the stock.
Okay, lots of Vinny stocks today showing green on the back of results at least. Thanks for that, Vinny. Let's go to Vamakshi now. She's watching out for a couple of other mid-caps as well that are in focus. Vamakshi, morning. So Aarti Industries and GE Verona on your radar?
Well, absolutely, Surbhi. Aarti Industries expected the stock to open in the red, and that is because it was a weak set from the company. Revenue saw an uptick of almost 12%, but the EBITDA was down nearly 16% after the operating margins contracted from 16% to 12%. The net profit too declined by 43%. In fact, the company has gone ahead and lowered its EBITDA guidance from FY25 from 1,450 crores to 1,050 crores, and the EBITDA is expected to be between 1,800 to 2,200 crores in FY28. The company says that the sharp dip in margins is mainly on account of its key product, MMA. They also witnessed lower utilization amid high channel inventory. GE Vernova TND is the next one I'll be watching out for. Very strong set of numbers coming in from this counter. Revenue, EBITDA as well as net profit are at a multi-quarter high. Revenue saw an uptick of almost 59%, came in 15% higher as compared to street expectations. Gross margins expanded, EBITDA margin expanded from 8.7% to 18.5%. Resultantly, we're seeing a very sharp uptick in the EBITDA as well as the net profit. Ordering activity out here was also quite healthy. The company's, in fact, order backlog stood at a record high, and they witnessed an order inflow of almost 4,680 crores, which is a very strong inflow. So overall, going with a green for GE Vernova TND.
On the ball as always. Thanks for that, Vamakshi. Well, let's hop across to Abhishek. He's here to tell us about Equitas SFBA. Morning, Abhishek.
Morning, Nigel. So it looks like the continued pain is seen in the rural economy because MFI or microfinance is hurting all the lenders. So Equitas, they have reported weak return ratios second quarter in a row due to elevated stress in the portfolio. So slippages have increased by 31% quarter on quarter. However, the slippage ratio is at 5.5% versus 4.5% in the previous quarter, which is on the higher side. So gross NPA ratio has inched up, net NPA ratio has inched up as well. Their net interest margin has fallen quite sharply to 7.69% versus 8.43% in the same quarter last year and about 7.97% in the previous quarter. With reference to the P&L, both the NI and PAT is below our poll. PAT is at less than 13 crore versus our poll of 157.6 crore. Utkarsh Small Finance Bank also saw a deterioration in asset quality. The slippages have increased massively over there, almost 250% on a sequential basis. Annual slippage ratio over there is close to 7.5%. Satin Credit Care, they have reduced their FY25 guidance with respect to loan growth to anywhere between 8 to 10% from 20% guidance that they had given in the previous quarter. Back to you.
Okay, all right. Got that, Abhishek. Thank you very much. So we'll keep some of these lenders also on the radar, specifically wherever we're seeing a lot of asset quality pressure build up. Let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow are Divi's Lab, LIC, Fortis Healthcare, and GE Vernona T&D. While stocks with negative news flow are Asian Paints, Tata Motors, Aurobindo Pharma, Ola Electric, Aarti Drugs, and Equitas Small Finance Bank. Okay, so that's our list in terms of the stock board this morning. Plenty to keep our eye on. Also, let's get a roundup of all the commodity market action. We have Manisha Gupta joining in. So, Manisha, morning, the big events are finally settled. What's the latest in the commodity markets?
Oh, well, yes, the market's still digesting the last week's big events right now. And with that, we've seen the crude oil prices extend its declines. Remember, Friday was 2 to 3% of a cut, and Monday morning is 0.5% of a decline yet again. Well, the China consumer inflation is coming in the lowest for 4 months. The storm Rafael in Gulf of Mexico seems to be easing. And the markets, in any case, are expecting crude oil surplus in 2025. So that continues to weigh onto those markets there. But it isn't a different picture when it comes to metals. Gold, after putting in the biggest weekly decline in 5 months, has continued to decline today as well. Same is the case with the metal prices trading under pressure, the strength in US dollar, and the fact that China did announce $1.4 trillion package for local government, but China absolutely refrained from delivering targeted stimulus injections, and that's weighing onto the markets. So base metal prices, after declining in the previous week, have started Asia quite flat to negative right now as well.
Thank you very much for that. Asia continues to come under severe pressure. Hang Seng is down close to about 2.4%. Kospi is down 1.5%. US markets closed up with considerable strength. Last week, the US markets ended with gains of nearly 4.5% on the Dow, the S&P 500. The Nasdaq outperformed, but somehow we're not able to carry forward that momentum in Asia. For China in particular, there is also the disappointment from NPC, which failed to meet elevated expectations. There was no word on a property stimulus or a stimulus to boost consumption per se. So Hang Seng, China are retreating quite a bit. And the GIFT Nifty, last week, with all the volatility, we were largely flat. But the GIFT Nifty right now, I think, is suggesting a slightly lower start.
Okay, well, let's, on that note, move ahead and get our first corporate conversation going. The stock and company in focus is Ashok Leyland. The second quarter came in slightly above street estimates, actually, as estimates themselves have been running very low because the CV cycle has been in a bit of a logjam. The company managed to post margins, above estimates. There was expansion both sequentially as well as year on year. Ashok Leyland also reported the 7th consecutive quarter of double-digit EBITDA. We have with us now Shenu Agarwal, MD and CEO of Ashok Leyland, to talk about the performance and the outlook. Mr. Agarwal, thank you very much for joining in. So you've managed to meet estimates with the reported numbers, despite, of course, these are weak numbers if we compare it to the previous years. What is the overall outlook and what are the trends that you can highlight for the second quarter? What worked for you in terms of especially the EBITDA performance?
Yeah, listen, we are very happy with our margin story. This is the 7th consecutive quarter for Ashok Leyland to post double-digit EBITDA margin. I think our trajectory is not yet done. A year and a half ago, when we went to the investors and analysts, we had promised that we will gun for a mid-teen EBITDA over a medium term. But we are very happy that quarter on quarter, we are posting a healthy increase in our EBITDA. Now, as far as Q2 is concerned, specifically, our EBITDA has been 11.6. And as compared to, Q2 of last year, which was at 11.2. So we have made considerable progress. Now, one thing that I think everybody would understand is that this has come actually at a lower revenue than last year. and the revenue was lower because of some setback in the CV industry that we have seen in Q2. But still, like I said, despite all these factors, we are very happy with our margin story.
So this medium-term guidance of mid-teens kind of margins that you've been talking about, while we have seen an improvement, the current margins are still below that level. When do you think you will be able to achieve that guidance of yours or that goalpost of mid-teens margins?
What we said was that we want to achieve a mid-teen EBITDA numbers in the medium run, right? Which could be like 2 to 3 years from now. But already, in Q2, we have hit about 11.6. I think we need to continue just our journey. I'm not sure about the timeline, although I have already said 2 to 3 years. But I think the more important thing is we need to just focus on our journey. The EBITDA margin improvement, there are a lot of opportunities within Ashok Leyland. I think the number one opportunity is to look at how we can build premium into our products, how we can extract better value from the customer for our products, by giving to customers what they value. So that is definitely one. Other big lever is how we can compress our cost, internal cost, whether it is the product cost or any other overhead cost. So that also, I think the trajectory has been very good in last 2 to 2.5 years. We think there is still a huge amount of juice left there. So that is another focus area going forward. And I think the third one I would say is that, we have, other than MHCV, we have some very good margin, high margin businesses like defense and aftermarket parts, and also power solution business. And even in international operations, our margins are very handsome.
Okay, Mr. Agarwal, let's focus on the main segment, MHCV. What is the growth range you're working with? After the first half of the year, I've seen almost no growth for the industry. Now there's an expectation of improvement in government. CapEx, even monsoon was fairly good. So what's your range?
Yeah, let me start from the beginning of the year as well, as far as MHCV industry is concerned. I think when the year started, most of us, and including some very prominent research agencies, were forecasting about 15% drop, in the first half of the industry. Now, against that 15%, we have dropped only by 2%. Yeah, so, and 2% drop is almost like flattish. So therefore, I think this whole narrative that is building, we have to be very watchful about this narrative that the industry is going southwards. Industry is actually almost flat for first half of the year. Now, breaking this into 2 quarters, Q1, the industry, MHCV industry grew by about 10%, while Q2, the industry degrew by about 12%. Now, the reasons for degrowth of industry in Q2, as far as we believe, are very temporary in nature. We started with a lot of extreme heat waves. Then there were uneven monsoon. There were also some extended monsoon, which actually in many parts of the country, which created a solution like a flood-like situation, where the fleet utilization went way down. Now, all this actually postponed, all that buying that was supposed to happen in Q2. Also, there was a slow pickup in government capex after the elections, which generally is the case, but I think this time it was a little bit more slower. Now, all these factors are temporary because we know that fundamentally, if we look on the ground pulse, we see a lot of positives. In October itself, we have seen fleet utilization, which fell as low as 60 to 65% in July and August. It is back to about 90 to 95% in October already. We see freight demand coming up. We see freight rates coming up. Right. So overall, I think in the back of a good monsoons, in the back of government capex now coming in full stream, and a lot of activity that we are seeing in construction infrastructure space, I think H2 should be a good time for the CV industry.
Okay, that's good to hear, sir, because it's been a while, several quarters of absolute sluggishness, right? So you're saying second half is going to be better. Can you give us some sort of a range? I mean, maybe for the medium and heavy commercial vehicle segment, for yourself or for the industry at large, what's the growth for the full year, given that you're expecting a strong second half?
So see, if you refer to some of the very recent reports by market research agencies, they have forecasted that MHCV industry could be, for the whole year, could be between 0 to 3%. Now, for that to happen, for 0 to 3% to happen for the overall year, H2 has to grow somewhere between, let us say, 6 to 10%. Yeah, so those are the numbers that have been predicted by some of the market research agencies. Our estimate is not very far away from that.
Okay, so 6 to 8% could be the MHCV industry growth in the second half. So now let's talk about your EV arm, Switch Mobility. Can we expect this segment to achieve break-even this fiscal? And how is your order book looking like?
Yeah, we are very happy with the progress that both Switch and OHM has made. You know, Switch is a company that focuses on building products for the electric bus and the electric LCV segment. And OHM is our EMAS subsidiary. You know, as far as Switch is concerned, our focus in the last couple of years has been in developing new products. We are very happy that we are almost going to be completing development of a completely new 12-meter low-floor bus that we are going to supply to Delhi and Bangalore. Our order book is at its all-time high. We have close to 2,000 bus orders now in our fold. We are producing all these buses as we speak. We are ramping up production as much as we can, and we hope to deliver all these orders in the next 12 to 15 months. So Switch, as far as Switch is concerned, we think not only it will be a big jump in their top line in the next 12 to 15 months, but also we expect Switch to break even on an EBITDA level very, very soon. It might happen either in Q4 of this year or at best Q1 or Q2 of next year.
Thank you very much, sir, for joining in. That's the word coming in from Ashok Leyland. It's now over to Anuj for a quick trade setup. Hi, Anuj. How's it looking?
Morning, Rima. You know what, as they say, it's the economy is stupid. When you talk about elections in the market, it's about the earnings, and that's what it is. The Asian Paints numbers just show you why the market's been falling. I mean, that at the end of the day has been the bottom line of this earnings season. It's been one of the steepest downgrades that we have seen all through the earnings season. And when companies like Asian Paints start to miss on all kinds of estimates, I mean, I don't remember in last 20 years, barring that COVID year, when did Asian Paints report this kind of numbers? This could well be the accident of the day. And as you know, been making out, Jefferies has lowered FY25 earning estimates of 63% of its companies, steepest downgrades since the COVID year of 2020. So it's clear that Indian market falling because of its own reasons. US election was never a trigger. It did prove a trigger for a bit of a short covering rally, but that's it. Coming to levels then on the Nifty, we are likely to open at the first support zone of 24,050 to 24,100, which is the Friday low. And then after that, 23,800 to 23,850, the recent low, that comes in picture, because if you break that, then the 200-day moving average is not far at 23,500. The resistance is at 24,250 to 24,300, the Friday high, and then 24,500 to 24,550, last week's high, and also the classical 20-day exponential moving average halt, which we saw last week. On the Bank Nifty, which has been one shade better, holding the 100-day exponential moving average and the October lows, those are the support levels then to work with, 51,100 to 51,200, the 100-day exponential moving average, and then 50,200 to 5400, the October lows. If you have a rally, in that case, the resistance is at 51,800 to 52,000. That's where you collapsed on Friday, first at 52,000, then at 51,800, and then, of course, 52,300 to 52,500. The other problem for the Bank Nifty is this relentless FIS selling. So rallies in stocks like HDFC Bank and ICICI Bank is not sustaining. For example, ICICI Bank has given up all of its post-result rally. And even SBI's numbers failed to enthuse the street. There was the wow factor which was missing in SBI as well. So let's see. For now, I think it looks like we are in for another weak start. And after that, we take it from there.
Okay, all right. Got that, Anuj. Thanks very much. So, yeah, let's see if we can deal with this initial gap down that we are in all likelihood going to witness. Well, let's take a quick break on that note. Come back on the other side. We'll have Prakash Diwan join in. We'll go through some of the weekend numbers and get a couple of fundamental stock ideas going.
Welcome back. Hope you're having a good morning. Well, we've listed on all the top stocks you need to track. Let's get in Prakash Diwan to help us out with some fundamental analysis. Hi, Prakash. Good morning. Top of mind, Asian Paints. Stock down 10% in the last 1 month or so. It seems someone was sniffing a weak set of numbers. but the numbers are indeed very, very disappointing. Large miss in comparison to estimates. Though they're guiding for better second half of the year. The con call as well will give us further details. But what's your view on the stock? If it opens down, then what do you do?
Good morning, Nigel. No, so I definitely believe this is a howler of number. While we knew that the competitive intensity was impacting the company's earnings potential, this has come as definitely a little bit of an unpleasant surprise. But the reasons that we attribute this to in terms of the extended monsoon, delay in that consumption pickup, could well be the opportunity that things could probably improve going forward. Now, whether that happens immediately in the next 2 quarters or it takes much longer will, of course, depend on how confident the management is. And I'm looking forward to listening to them in some time on your channel. But very clearly, this is where I think it bottoms out. We knew that competitive intensity was impacting it. Opus has done what it wanted to, it had to do. So probably now you may not have negative surprises. And remember, margins will probably not be as impacted going ahead, given the softness in crude, given the softness in other raw material inputs that they have. So my sense is that they'll probably be able to get out of this in some time. For long-term investors who like the business model, probably a good opportunity to buy. I know it's a contrarian call. Everybody's been talking about downgrades and all. But even after the downgrades, it's not something which is going to be earth-shattering. I mean, at 2,700 plus, it's not something that we are really staring at in terms of a potential loss. So the risk-reward does get favorable, but if you are willing to hold on for the long term.
Target prices set by brokerages are much lower. So JP Morgan today has downgraded it to an underperform. Their target price is 2,400. For Jefferies, the target price is all the way down to 2,100. And one more problem for Asian Paints versus peers who've managed to report a small volume growth of about 4% odd is Asian Paints has a higher dependence on urban India, where the consumption slowdown has been a little more pronounced. Prakash, do stay on. Need to get into a break. We'll come back and talk and invite Mitesh Thakkar and Sudarshan Sakhani for a few technical trades. Stay tuned. Welcome back. On Friday, the Nifty closed at 24,148. This morning, the GIFT Nifty is suggesting a slightly lower start. Will we manage to hold on to Friday's intraday low of 24,066? We're about 70-80 points away from the spot level close on Friday. Mitesh Thakkar and Sudarshan Sakhani join in on the show now. Good morning, gentlemen. Mitesh, how would you approach a gap down opening?
Good morning, Rima. So I think, the only positive in this entire setup is that the PCR ratio of Nifty and Bank Nifty suggests that we are now very close to oversold levels. Opening about 100 points, I think 99 or 100 points down from current levels means that we'll open around 24,050 odd area, and 24,000 is the first support zone. So I'll watch that level closely. In case we see a reversal pattern on the half-hourly chart, maybe approach along. But in case we start breaking below 24,000, then I think the recent lows of 23,850 should be retested, and then we'll take it from there. So as of now, in the opening, I would want to take a trade. But post that around 24,000, if there is some support and reversal seen, then I think maybe we'll approach a long position.
Okay, all right. Thanks for that, Mitesh. Sudarshan, what about you?
Yeah, good morning. See, the critical levels are, at least for the Nifty, are that low that we made last week. So that's a zone between 23,800 and 23,900. So that zone is the point at which the markets will decide whether they want to hold on to it, they want to build upon it as a base, or they want to break down and go further down. Now we don't have the answers right now, but the trade is that so far as 23,800 holds, I don't think we're looking at any shorting idea. The idea is that a sharp dip remains a buying opportunity. But remember those zones. Once that zone breaks down, there are no long positions. Till then, look for sharp 100, 150 point dips to go long.
Okay. Point well made. We'll slip into a short break, gentlemen. We'll come back and get in your stock ideas for the day. We'll also have the pre-opening rates kick in. And also, we'll talk about State Bank of India. Nyandan Vaidya from Axis Securities will be joining in on the other side.
Welcome back. So let's continue the conversation with our technical experts and get some stock-specific ideas going as well. Mitesh and Sudarshan are with us. Gentlemen, morning to both of you. Mitesh, let me come to you. Stocks?
Good morning, Surabhi. I have a mix of buys and sells, primarily because I'm hoping that post the gap down opening and with the oversold levels, if we can reverse from 24,000, there'll be long opportunities to explore. So I have a buy on Cummins with a stop at 3615 for targets of 3,800. BEL on a decline around 293 to about 291 is the buying zone. So if it opens around those areas, buy with a stop at 286.5 for a target of 305. On the sell side is Coal India. Keep a stop at 429, look for targets of 410. And Bharat Forge is a sell with a stop at 1440 for targets of 1375.
Sudarshan, hi. What would your picks be?
Yeah, good morning. It's mainly mid-caps. And remember that the mid-cap index is actually outperforming the Nifty. Now, this is relative outperformance, but it's still there. So Cummins is a buy with a stop under 34.80. Jubilant Foods, which has also gone through a deep correction and is now stopping that correction, is a buy with a stop under 595. Altas, which has already been an outperformer, has a mild correction that may be ending. Consider buying with a stop under 1690. And Ashok Leyland is the final buy opportunity with a stop under 210.
Okay. All right. Got it. Thank you very much, Sudarshan, for that. Mitesh, to you as well. We'll come back to you a little closer to market opening. Let's go back and take some questions with Prakash. Prakash Diwan, of course, has been in conversation with us. Morning to you, Prakash, from my end. Tata Motors. I think this is a nice debate, right? Numbers are nothing great, huge margin compression, worst second quarter. But look how optimistic they're sounding. On the India business and on JLR, they haven't cut back their guidance. They're still saying they're on track with the debt reduction program. So then, buy, sell, hold, avoid. What is it? You're on mute, Prakash.
My apologies. So I said good morning, Surabhi, but exactly last year, it was the management that was trying to caution all of us when the stock was at about closer to its highs of 1100. And that's panned out. Now, if they're as confident to complete the full FY25 with the guidance that they had earlier alluded to, I don't see any reason why the stock cannot make a comeback. And secondly, I think their confidence stems from two things. One is the balance sheet structural change that they're talking about being net zero. So that's going to be a very, very major thing that takes away all the potential shocks that they could get from any kind of a setback. The second thing is that the EV portfolio that they have, they're talking about revamping that and focusing much more on that. They're already leaders. Of course, EVs haven't done so well within the domestic market, but I think there's another plan afoot to demerge the commercial vehicle business, which probably is a bit of a drag at this point in time when you buy the stock. So if those changes are afoot, I don't see any reason why the stock can't make a comeback. Of course, not go back to 1100 as quickly, but at least from these 800 levels, another 20% upside could definitely be penciled in. So I'm quite positive on this, given on the back of the management commentary and the environment in which we are in terms of the auto sales and auto sales pickup and things like that. So pretty interesting. But then you have options like M&M and Maruti, to choose from. So it becomes a little bit of a tougher choice. But on a standalone basis, Tata Motors is definitely a buy. It doesn't make sense to sell it at this level. People could choose to hold, but as I said, if you're willing to ride that turnaround, then definitely you get that 20-25% upside.
Prakash, you're in a full stock buying mood today. You're going to buy the dip on Asian Paints. You believed it's bottomed out. Tata Motors also, no hold, go out there and buy. So, yes. Someone's out there with cash sitting to, buy things.
And it also helps, right? Because prices have come off. Tata Motors are 30% off, and Asian Paints itself is well off the peak. So I guess that makes the buying decisions a little easier.
Okay. So Prakash, what else, right? We had so many companies which reported numbers over the weekend. Which one is your pick of the lot?
So Rima, when I say, these are viable names, it's primarily, especially Asian Paints seems like a very big contra bet. The reason I say is on a quarterly basis, it has a profit pool of 8,000 crores, which is actually more than all other paint companies put together, whether it's Kansai, Akzo, the smaller ones like Shalimar and, your Indigo and all of that. So you can't get these stocks. So good news and good prices don't come together anyway. So that's where my thesis is. On other numbers, if you look at a small company like Sami Hotels, it's too small. We don't see it being discussed so often. It just had a little bit of a recent history post the IPO. But that space is looking so promising. We saw the numbers from Indian Hotels, right? They were so impressive. And what's happening is going forward, the number of keys that are getting added in the market that's going to take a long time. It's not so easy to meet the demand. And the demand gives them the pricing power, which only starts improving the asset sweating. So from that perspective, it's a very small unit, is efficiently run. The numbers are impressive. And Sami Hotels is something which you could probably see becoming much bigger over the next few years. And I think you'll have to look at these slightly under-discovered names to make money going forward. I'm not necessarily saying large caps, but within the mid-small caps, there is enough potential salience that you could start filtering out.
Okay, so for Sami Hotels, the numbers were out over the weekend. A revenue growth of 20%, margin expansion to 34% versus 23%, and the company has clocked in a profit of 12.6 crore versus a loss of 88 crore in the comparable quarter of last year. So turnaround for Sami Hotels, and that is Prakash's pick for the day. Prakash, thank you very much for joining in. Let's talk about State Bank of India. Well, the numbers were good, a 28% growth in the company's profit. As higher treasury income lifted the earnings, there was an improvement in asset quality, yet the stock on Friday slipped and was under pressure. So to talk more about SBI and the banking sector outlook, now that all the big earnings are out of the way, Nyanda Vaidya, research analyst BFSI at Axis Securities, is now with us on the show. Thank you very much for joining in. Did you speak to your clients about clients about State Bank of India? Are they willing to buy at current levels? What is the call now?
Hi, good morning. So yes, SBI did report a good set of numbers and we continue to remain positive on the stock. Asset quality, unlike some other big banking players, has not been a problem for SBI. We've not seen any stress in terms of slippages. So yes, we do continue to maintain a buy recommendation on the stock with a target price of 1,040.
Yeah, which is still a reasonable upside from here. Nyanda, great to have you on the show. So I think this is something that has been a huge relief, right? The larger banks don't have the kind of asset quality and credit cost issues that are building up in smaller lenders or lenders with the microfinance exposure. So SBI is a buy for you. We are at the end of more or less at the end of the earnings season as well. What else stand out where you will get reasonable asset quality or credit costs within control? And maybe some growth as well, because on the other hand, there's this whole fight for deposits and trying to protect margins. Who is winning that fight?
Right. So we continue to prefer the larger private sector banks. So we continue to remain positive on ICICI Bank. We don't see any major asset quality challenges in the bank. Also, HDFC, if we look at the bank, it's been able to maintain its asset quality across cycles. Currently, it's been dealing with the higher LDR, which is an issue, and hence growth will decelerate in FY25 before picking up slightly in FY26. But we believe that valuations for HDFC Bank are pretty attractive, and we remain positive on both HDFC and ICICI in the private sector. Amongst the mid-sized banks, we like Federal for its valuation comfort and also healthy delivery on the ROA front. So we expect a continuous ROA delivery of around 1.3%, at least for the next couple of years. Of course, the sector will face some headwinds on margins once the rate cut cycle begins, but that will be across players. In the PSU space, we like SBI.
SBI, yeah, that remains your key pick. So ICICI, HDFC Bank and SBI, all are three large cap banking picks. On SBI, let's just talk about this whole asset quality issue. As of now, there's absolutely no problem, right? I think it's all very well under control. The slippages number was also fine. Are you expecting any kind of hiccups at all in that target price of 1,040? What all are you penciling in terms of how much growth? What kind of NPA movements? Just tell us a little more.
Yeah, so in terms of asset quality, there was a slight inch up in the SMA book because of a PSU account, but that's been pulled back. So we don't see any major asset quality challenges either from the retail or the corporate segment. So asset quality, in our view, should remain largely stable going ahead with controlled slippages. So credit costs eventually should also remain largely range bound between 50 to 60 basis points. In terms of growth, the bank has also alluded to strong growth demand coming in from retail assets, and also there is some pickup seen in certain segments. So that should aid credit growth for SBI. So we are penciling in around a 15% CAGR growth over FY24 to 27 in terms of credit. In terms of deposits, yes, there has been a lot of competition across players, and but SBI remains well placed when it comes to a balanced LDR. So we expect that the deposit growth will continue to remain healthy. However, that growth will remain slightly lower below the credit growth, and we are penciling in around an 11% CAGR growth in terms of deposits. So margins should remain largely steady. So our estimates say that SBI should deliver an ROA of at least 1 to 1.1 over the next couple of years.
Okay. And finally, before we let you go, Nyananda, just comment on the whole issue on MFI. That stress has showed up everywhere. We're looking at smaller lenders, MFI lenders, or today's Equitas, the stock's already down 3.5%, 4% in pre-open. We know what happened with credit access. On MFI, how much more pain system-wide would you look at? And also throw in a word on unsecured. If we should be expecting any accidents in the second half on that side.
Right. So MFI has been facing some problem even in the first quarter. So first half has been bad, and we expect the second half to see elevated slippages and elevated credit cost, with lenders having a higher share or having a higher exposure to the MFI segment. While commentary from lenders has been that October collections have more or less stabilized, we still see some kind of stress flowing in, resulting in elevated slippages. So yes, that will continue to hurt the asset quality and credit costs for lenders. In terms of unsecured, other than the MFI segment, there is some stress in the credit card portfolio, which will continue to show up in Q3. We'll wait and watch for trends in Q4, but overall, for the unsecured space, we believe that H2 will not have a very bright prospect.
Okay, so MFI and non-MFI unsecured, they remain key watch points from an asset quality perspective, even in the second half. Ananda got that. Thank you very much for joining in. Let's quickly go back to our technical experts for the 9-10 calls. The pre-open has settled with about a 60-point cut on the Nifty. And Asian Paints in the pre-open is taking a knock of almost 8%. Sudarshan, your 9-10 call.
Well, consider buying Voltas with a stop under 1690.
Okay. And Mitesh?
Sell on Coal India with a stop at 429, targets of 410.
Let's also talk about Tata Motors. That's going to be in focus. Sudarshan joins in for more.
That's right. So Tata Motors stock was under pressure going into earnings. Even stock is down 32% from the 52-week high that it had hit on July 30th. But earnings have come in below estimate, but outlook given by both Tata Motors and JLR are positive. What does Tata Motors say? It says CV demand is expected to improve significantly in H2 FY25. Also, if you would have heard Ashok Leyland's comment about H2 FY25, company had said that CV demand growth as per the industry's forecast is seen in the range of 6 to 10% H2 FY25, translating to 0.0 to 3% growth for FY25. Also, Tata Motors say business will become net debt free by this year. Talking about JLR, it expects EBIT margin, basically it maintains EBIT margin guidance of at least 8.5% or little more than that. Brokerages are largely positive on Tata Motors. CLSA has upgraded the stock to outperform and target is to be 968 per share. Nomura also maintains buy call, but target is cut to rupees 900 from 1300 per share. It says strong rebound in JLR in H2 FY25. Also, India CV recovery is likely by Q4. Jefferies maintains buy call and target is cut to rupees 1000 from 1330 per share. It said JLR expects a much better in H2 and maintained its FY25 margin guidance. UBS though maintains sell call and target is cut to rupees 780 per share.
Okay, thanks a lot for that, Sudarshan. Well, Trent has been the stock in focus. It's been nervous post its numbers, but there's an initiating coverage on the stock. Hormuz is here to tell us more. Hormuz?
You can't keep Trent out of the news, can you? And Goldman Sachs has initiated coverage on the stock, a buy recommendation, an 8,000 rupee price target, a 27% upside. The stock itself is down 25% from its peak. Mind you, the price target is lower than the record high that Trent had made, which was around 8,345. Now, Goldman Sachs says that it's a multi-year share gain story with a low competitive risk, and Zudio's business model being difficult to replicate gives it an additional advantage. It is expecting a revenue, EBITDA and a profit CAGR of 28%, 34% and 29% respectively over FY24 to FY30. And it says that it is expecting Zudio's market share to gain from nearly 1% currently to over 5% from FY24 until FY35. So a positive note coming in from Goldman Sachs, expecting a 27% upside on Trent.
Okay, after the kind of drubbing the stock has seen, maybe the buyers will emerge. Thank you very much for that, Hormuz. We'll keep Trent on the radar. Right now, that stock's also down in pre-open. So the screen here actually looks a little better than a lot of the other Asian markets that are seeing a deeper shade of red. This is not too bad. Let's see if the buyers can actually come in at the lower level. What happens after the opening gap is going to be critical to watch. Britannia, by the way, is reporting numbers today, and the stock's up about 1% ahead of that. And there seems to be some buying in select banks and select IT stocks. That's the pre-open indication as we start off somewhere around the 24,000, just under the 24,100 mark. So the bell has gone, and the early start is about that 80-point gap down. That's the Nifty for you, down about 0.4%. Mid-cap index is losing a little more than that. It's down about 0.7%. Bank Nifty also down in sync with the Nifty, at least as we speak. Asian Paints, of course, is taking a hard knock. 8% down on the real howler of our second quarter. Dr. Reddy's, Axis Bank, Hindalco. These are some of the early sort of movers on the way down. You have some heavyweight names like Reliance, L&T, which are also dragging. So, it's a 0.5% drop now on the Nifty. It is a very, very cautious start. 120 points gone from the Nifty, and the fight continues around the 24,000 level. Guys. All right.
Well, let's take a look at a few other stocks. Aarti Industries have gone ahead and cut their EBITDA guidance, I think. So that stock is down close to around 6%. Utkarsh SFB, the asset quality issues continue. So that stock, in fact, is down close to around 6%. Premier Energies, well, the numbers look good. The problem is the stock had run a lot. So that's why that stock's down close to around 4.5%. And Indus Towers, there was so much of optimism at around 440 rupees. Now the stock is corrected around 320 rupees. I think in line with what we've seen with Vodafone Idea. That stock as well as half from the top, and that stock is under pressure even today. On the flip side, SCI, that's a stock that's done very, very well. It's up close to around 8%. Not sure about the news flow on that one, but that's moved well. PFC came out with a set of numbers. It seems the street likes it. They like what they've heard from the brokerages as well. So that one's up close to around 2%. And Biocon, some positive news flow that came in for one of their units. So that stock is up close to around 3.5%. Welspun Corp, the stock has run a lot, but the street has read these numbers. I think the operational performance actually was better than what Phillip Capital was estimating. For the time being, Welspun Corp has opened with a cut, I think, of around 7%. Though from the lows, it's seen a bit of a recovery. It's now down close to around 5%. Second half of the year should be far better. ITI as well is up close to around 2.5%. So some green out there, but the advanced decline ratio is clearly in favor of the number of stocks that are declining, close to around 2:1 as we speak. And a few more names actually that deserve special mention. Oro Pharma up close to 2%. Ashok Leyland, we heard the management earlier today. That stock as well has opened up in the green. On the flip side, oil prices have fallen a little bit, so Oil India is down close to around 2.5%. We're 100 points lower. The reference point on the lows on the downside today is 23,950 on an intraday basis. Rima?
Well, the small cap index is down more than 1%, so there is a lot of pressure. Many earnings reactions. So Advanced Enzymes has opened with a cut of about 7%. Here, profits have declined on a year-on-year basis. Even MapMy India, which is listed as CE Infosystems, this was a company which over the past 2 or 3 years was growing between 30 and 40%. But this quarter, for the last 2 quarters, Q1 and Q2, the top line growth has only been about 13-14%. And the company is talking about a slowdown in the consumer and enterprise business. Autos have done well, but the other part of the business, X of autos has come under pressure. So CE Infosystems straight away, 6% gone. Dreamfolks too, down nearly 6% on very large volumes. Jupiter Wagons has reported a drop of close to about 5%. Again, these are all stocks reacting to numbers. Relaxo Footwear. We've seen profits fall by nearly 15% for Relaxo Footwear. Whirlpool too looked okay, but the stock is correcting as we speak in early trade. On the way up, GE Vernova, that's up 5%. Jupiter Lifeline Hospitals. The numbers look good. I think profits went up over here by 50%. So it's having a good start to the trading session, so 4% up on that. Samhi Hotels, a stock that Prakash highlighted, as a unique trade. It's a recovery in the hospitality business. So Samhi Hotels is up close to about 2 to 3 odd %. But I think the accident of the day is clearly Asian Paints, 7.5% gone. It's a fresh 52-week low on Asian Paints, and there is no recovery so far. So Asian Paints continues to bleed on the way up. The top two gainers are Maruti Suzuki and Tata Motors.
Yeah, absolutely. I mean, Asian Paints indeed is really pinching this fall in volumes, a huge sort of cut in margins, fall in margins we've seen year on year. So this one continues to take all the negative headlines. Ashok Leyland is now trying to put on some more gain because the management's commentary, as you heard, is very, very optimistic on the second half, saying that the fleet utilization rates are now going up to 90%. There's more demand for freight. Freight rates have started improving. So they're looking at perhaps hinting at maybe we're at some kind of a bottom for the CV cycle. So Ashok Leyland is a very, very interesting one. And GE Vernova, Vamakshi highlighted the numbers earlier. They're very solid numbers. And the stock's been up on 5% upper circuit ever since. Trent, by the way, the report that Hormaz was just highlighting, Goldman Sachs saying 8,000 is possible on the stock. Well, 6,347 today. So some green on Trent.
Well, DCX Systems, they have won an order. So that stock is up close to 5%. Volumes was fairly large for the first few minutes. PPAP Automotive, that's coming as one of the top winners. Volumes not very, very high. Only 50,000 shares have been traded. So that's up 13%. And Vimta Laboratories, that one as well is up close to around 13%. Arius Agro as well, that's another stock out there. Close to 2 lakh shares traded on Arius Agro. The stock is up close to around 10%. Vimta Labs as well, more than 5 lakh shares traded out there. So that's moved up. And SCI is another one with very, very high volumes. It's more than 35 lakh shares just in the first 4 to around 5 minutes odd.
Okay, well, the market's also trying to now pull back from the lows. The cut was about 120 points at the lowest level. Now it's about 86 points. So let's see. It was always the big question of the morning. Will the opening dip be bought? And we'll have more clarity over the next couple of hours. Let's get the conversation going then with our market master of the day, Gautam Trivedi, managing partner at Nepean Capital, is with us. Gautam, thanks so much for joining in. Hope you had a great festive season and enjoyed the rather big eventful week in the markets that we had last week as well. So let's start with India, actually. We'll talk about Trump and tariffs and all of that in a bit. But India, because this is a market that's not used to consolidation anymore, right? Up till September, it was a buy every dip market. Dips were as shallow as 2-3%. But now we've got this 8% fall, and now we're trading in a range. Do you expect more of this ahead?
Subra, you raised a valid question because when the market was going up, nobody complained. Everybody was happy. The media was happy. Investors were happy. Companies were happy, and everything seemed like this party could go on for another 12 to 18 months. But I'm kind of glad in some way that the reality has set in, that there is gravity. And if you look at the way some of these stocks have fallen, especially the mid and small caps, I think it is a wake up to the fact that stocks can correct and the market can correct. But getting back to the real cause of what's causing this correction, I think if you look at the peak of the market, which was on the 26th of September, 216, I think, was the level of Nifty. And, as you said, it's been an 8% correction since on the Nifty itself. But here's the thing. I think, foreigners weren't really that active in the first place year to date in India, if I look at it from January onwards. But they got a perfect reason to actually sell when China suddenly took off. So this was a very sudden move by the Chinese government to revive their economy. They haven't come up with more specifics on what they're exactly going to do. But the fact is that became suddenly an alternative to India within the EM space. And I think that's when the selling started. Now, to your question specifically on how much more can they sell, let's look at it this way. As of the 26th of September, foreigners owned $1 trillion of India's $5.7 trillion in market cap, roughly about 17%. They've sold about $13 billion, or 1.3% of their total holding on a mark-to-market basis. Can they sell another 0.7? Can they make it 2.5% from 1.3? Quite possible. What can cause that to happen? We've got an earnings slowdown. I mean, it's very evident in the results, so no surprise there. But the reality is that even back home in the US, if you look at the earnings growth for the S&P 500 for calendar 2025, it's as high as 13%. That's the consensus number. So, we are looking at 14 to 15% earnings growth for fiscal 26. We have competition from the US back home itself. And of course, don't forget China. China also consensus earnings growths are 12 to 13%. So we still have that, of course. Yeah.
Yeah, Gautam, I want to, sorry to interrupt, but I really want to compliment you because I remember that conversation that you had with us a couple of months back. You'd come to our studios that time and you had just returned from a US trip and you were telling us that it is so red hot. We were talking about room rates, I think, in New York, right? And that's when you kind of flagged off just the sheer power and strength of the US economy. And guys, I just wanted to bring this back to the table because I think even before this became the center narrative of investing more in the home market, Gautam kind of gave us a tip-off because he'd seen it on ground there in New York.
Okay, all right. Good one, Gautam. Hi, Gautam. Good morning and good to see you. Zomato is something that you like, right? I think that's one stock that we have discussed in the past. Now you have Swiggy, so you have an option out there and they have come at a sharp discount in comparison to Zomato. What's your view on that IPO as well as, since Zomato has come off a little bit from the recent peak, your view on the space on the whole?
I think the market's increasingly looking at both of these companies from a quick commerce perspective and how deeply penetrated they can get. Of course, there's a third player, which is Zepto, and then you've got the incumbents like a Reliance Retail, and you've got DMart. And of course, they're getting aggressive, Big Bazaar as well. So I think the competition in the quick commerce space is intensifying, but the market's increasingly looking at both these listed companies as a means of figuring out, again, I'm underlining the word listed companies because the reality is that it's all good when you look at a sector, when you look at stocks within the sector, but what is listed? Which way can a public market investor actually play the sector? And there are only two right now. Well, there was only one, but there's a second one that's getting listed shortly, which is Swiggy. So my view is that quick commerce is here to stay. The next generation, including my two boys, they don't want to walk into a Kirana store and actually buy anything. They haven't been to a Kirana store probably in years. It's just easier for them to place an order, whatever it is they want, whether it's shampoo, whether it's soaps, or something to eat. It's easier to do it through your smartphone versus physically going to a store. So I think both these companies, the future growth is going to come from quick commerce, and that's what I think investors should be focusing on.
Gautam, what is your read of this earnings seasons and the disappointments that we've had so far in Q2? And what does it tell you? Is that expected H2 recovery perhaps not going to play out to the extent that the street is hopeful for? It's going to be a little more deep-rooted in terms of a weakness. And how should one approach stocks like, say, in Asian Paints? It was a darling, it was a big wealth creator. Are we looking at a bottom right now in Asian Paints or, perhaps not?
Yeah, let me answer the first part, which is in terms of earnings growth. I think if you look at, and we've been studying this over the last about 3 to 4 years, but specifically if I look at the last 3 years and quarterly results within the last 3 years, i.e. starting from the second quarter FY22 to our current quarter FY25. And the data that I have for the current quarter is as of the previous Fridays. Sales growth has gone, i.e. from the second quarter FY22, I'm reading this out directly, sales growth has fallen from 25.7% to 7.6%. EBITDA growth has fallen from 12.9% to 1.2%. And PAT growth has fallen from 38.6% to a negative 5.3%. Again, the caveat is that all of the companies in this current quarter haven't declared results yet, but based on the numbers so far, they're pretty disappointing. So yes, is there a slowdown? I think there's no question about that. Specific to Asian Paints and specific to the paint sector, Asian Paints I think is a great company. 8 days of working capital cycle, which is unheard of in India. I mean, outstanding management. It ticks all the boxes. But guess what? There are at least two big ones, two big industrial houses that have decided to get into the business, which is the Aditya Birla Group and the GSW Group. Deep pockets and are leveraging their existing relationships with cement dealers or steel dealers, as the case may be. And I think there is a business case for both of them to get into this business. So margins going forward, will they come back anytime soon? I doubt it. Of course, raw materials is an important element of margins and profitability, but I don't want to forecast what crude oil is going to be going forward. But the reality is, this space is something that we are currently avoiding.
Okay, that's interesting. Yeah, perhaps we're looking at a structural, downgrading in terms of that margin profile. That's a point well taken, Gautam. So to come back to the point where we started from, right? You were saying that today, I think the S&P 500, you said, right? Or it was the Dow, where average large cap earnings growth in the US is 13%. And then we have our own issues. Some of them we've already discussed. So where does that leave our market? More time correction, more price correction, because you're also not ruling out more selling from FPIs.
Yeah, so, here's the thing. We have a situation where the market for the past, I would say 12 to 15 months has not been driven by fundamentals. It's been driven by fund flows. So the numbers that are coming in month after month, and I haven't seen October's numbers yet unless you guys have, but the numbers that are coming in month after month still suggest that there is zero impact of the FI selling with respect to the flows that are coming in. And I was looking through Angel One's numbers. They've released their monthly numbers. The numbers are staggering. I mean, every month, irrespective of how the market behaves, they've seen a significant jump in net client additions, their average daily traded volume, and overall their funding book for clients. So there's no slowdown on that front. And I think that's something which is going to determine the future course of this market. It's not going to be earnings slowdown. It's not going to be FII selling. It's still going to be driven by the financialization of the Indian equity markets, which is spreading so rapidly that every week, every month, we're adding new first-time equity investors, which is great for the long term. But the fact is, have they seen a correction before? They haven't. And I don't know if this 8% correction is necessarily going to make them think twice.
Okay, all right, Gautam. Always good hearing your thoughts. Thanks a lot for joining in and giving us your take on markets as well as individual stocks and sectors. Well, let's turn our attention to Vedanta. I caught up with the Vedanta management's top brass. I began by asking them about the aluminium cost of production in the past quarter and what's the way ahead. Let's listen in to what they had to tell us.
If you look at our mix, our imported aluminum mix last year, same quarter, used to be around 51%. And we could bring it down to 43% imported aluminum mix. While when the procured OMC bauxite ore used to be 50% same quarter last year, it is also down to 43%. That is more and more we are getting backward integrated with our own alumina. And of course, this is reflecting on the cost. As the quarters go by, I'm sure that we should be able to maintain the same trend and we will be able to ensure ourselves that we protect our margin in spite of the spiking up of alumina prices.
So you don't see a big spike up in the cost of production on the aluminium side?
No, absolutely.
Okay, all right. So that's the biggest part of the business. So we've got the profitability question out of the way. Let's focus on the debt. The street is always skeptical. What's happening at the listed company entity with regard to the net debt? Now, you've reduced net debt down by close to 4,000 crores. And as you are mentioning, it's the multi-quarter low. The parent as well is in better shape. And they have deleveraged the books by around $1 billion. Give us an outlook, Mr. Goel. Where does the Vedanta listed company's net debt go from this 56,000 crores? And what about the parent entity?
Sure. Let me start first with the parent company, Vedanta Resources. And you're right, in the current year, first half, we have deleveraged the parent company debt by $1 billion. And with that, debt at Vedanta Resources has come down to 4.8 billion, which is almost half what it was almost 2 years ago. So it is at decade lowest debt at Vedanta Resources. At the year beginning, we have committed that VRL debt will go down by 3 billion over 3 years, and we are well on that path. Now, coming to Vedanta Limited, the listco, yes, debt in the current quarter has gone down by 4,500 crores. But here we should look at net debt to EBITDA, which is at 1.49x. And in near future, over 2 years, we will go down to 1x. That will be a benchmark in the Indian metals and mining space.
Interesting. The other fear is about the capex plans. You'll have this dream of getting into the semiconductor space as well, and you'll get some support from the government. But what is the total capex spend for the entire entity, since it's still one entity? Could you tell us about that? And how do you plan on funding it? What's the update on semiconductor?
So you may take the capex one, and on the semiconductor, yes, right now nothing beyond what has been already discussed in public. So we'll keep it at that.
But by when should we get a bigger update on the semiconductor front?
Whenever we feel that there is something more to talk about, it will come back.
We'll be waiting by for that. Mr. Goel, you want to comment on the capex?
Yes, on the capex, one can look at a block of 3 years because ours is a long haul industry in terms of capex cycle. So we intend to spend almost 5 billion capex over 3 years. And as you know, in the current fiscal, our guidance is about 1.9 billion and will be in that ballpark. So the 5 billion over the next 3 years, starting with next year, it will be funded all through operating free cash flows. And as you may have seen in the current year, we are reporting a very robust growth in terms of EBITDA and the free cash flows. So the entire capex program, 5 billion, will be funded through operating free cash flows.
So you don't see the debt balloon up from these levels of around 60,000 crores. It should hold in this vicinity?
In fact, the debt both at Vedanta Limited and Vedanta Resources should only keep going down in future.
Got it. Now we have one listed entity, Vedanta, but more the merrier is what the bulls on Vedanta will say. By when do we see the demerger take place? Give us a timeline.
Demerger should unlock substantial value. That is one feedback which is resounding from all the analysts' viewpoint. And you may have seen in the last quarter, 2 events, we filed the scheme of demerger with NCLT. And the first stage hearing has taken place in mid-October. And we are quite hopeful and optimistic that demerger will conclude by end of this fiscal.
Okay, got it. What about the sale of the steel plant? There was there was this talk that you all are going to be doing it, and you all have spoken about it in the past as well. Get the right value, we'll sell the plant. What is the current update on the steel plant? Are you looking to sell it or are you looking to add capacity?
On the steel plant, if you say there is a two-track strategy. One, of course, strategic intent. If we can hive off and concentrate on the businesses that we have, but that does not deter us from growing the business altogether. We are almost about to complete our expansion plan at Bokaro. By next year, March, the new projects will be up and running, including the new blast furnace, new coke ovens, everything will be up and running. And then we are also on the drawing board to invest more and expand the steel capacity to 5 million ton in the next stage. So we are not shying away from growth in steel business at all, including our iron ore and value-added business in Goa. While as a strategic intent remains, whenever the situation is right, we get the best value. So of course, we'll have a look at it.
So for the time being, you're focusing more on expanding the business rather than selling it. Is that correct?
Absolutely.
All right. Since we have both of you all with us, Mr. Goel as well as Mr. Mishra, what's the plan with regard to the international zinc business? There was a plan of bringing all the zinc assets under one umbrella. Is that still in the works, or are there any plans of selling the international zinc business?
No, so there are two parts to it. One part was whether merging Hindustan Zinc and Zinc International and make it in one business. That time there was no talk of demerger. Now there is a talk of demerger. So we have strategic organizations. So where this Zinc International falls under Base Metal Group, which is our operations in South Africa, and we will look at that growth of Zinc International under that Base Metal Group. And that growth immediately they are growing to 1 million ton capacity, with new concentrators coming up, mine being expanded. So that will grow on their own, and very fortunate parties, the reserve and resource that they have is slightly more than even what Hindustan Zinc has, and even on a similar comparable grade. So there is no corporate action required right now for merging the two. And whereas Hindustan Zinc in India itself is looking to double its capacity. So the strategy that we had that time, that we will go to 2 million ton capacity by merging the two businesses. Now, 2 million ton will come in India and 1 million ton in South Africa. Together, it will be 3 million ton. We are creating more value in this new strategic approach.
Got it. All right. What about Vedanta? They surprised everyone. They went and they sold some stake in Hindustan Zinc. And now Mr. Mishra told me, Nigel, I think the OFS is going to happen. And the OFS happened. The government of India came and sold some stake in Hindustan Zinc. Does Vedanta plan on selling more stake in Hindustan Zinc, or for the time being you're done?
See, there are two, government's intention of selling was a committed strategic choice that government had told in the Supreme Court, where government would be divesting their entire stake of 29.5%. So this is just the beginning. Vedanta's choice is depending upon its financial planning, where Ajay Goel would be able to throw light. There is no strategic intent, so to say. We want to run the business, we want to grow the business, and we want to make it, already we are second largest in the world. Of course, we want to make it the largest zinc company in the world. government's intent is concerned, I had told you the actions will happen sooner than later. They have happened with starting with 2.5%. And the next, what will happen beyond that, we will wait and see.
All right, Mr. Goel, you want to clarify whether Vedanta will sell more stake in Hindustan Zinc?
Say from a capital structuring and the funding viewpoint, with that robust operating free cash flows and recent fundraise through QIP, there is no need for further cash through OFS. But obviously, Vedanta is a large company, and we keep evaluating. Depending upon the interest and the right pricing, we will again evaluate in the near future.
Okay, all right. And final question then, does the promoter want to sell any more stake in the listed entity Vedanta Limited? Mr. Agarwal's in far better shape. Will he sell more stake? Or in fact, if he's in better shape, will he look to buy back some part of what he sold?
Again, in terms of overall structure for the group, our single biggest target of the group remains deleveraging. So be it Vedanta Resources or Vedanta Limited. But again, the prioritization viewpoint, it is the first free cash flows. Any options strategically in terms of a stake dilution, I think can be considered. Nothing on the table. But will you buy more? I think in the current environment, it is less likely, I would say.
But can he sell more?
There's no requirement, Nigel, as you know, but we keep evaluating. Nothing on the table for now is all I can say for now.
Okay, that's Vedanta on the second quarter performance. Plus, of course, a lot of the strategic moves anticipated ahead. Stock right now is a little flat, but the market has recovered very smartly, mind you. Look at the Nifty from the intraday opening gap down of about 100, 110 points. The market's now fighting hard to go in positive territory. The Nifty did turn green also while we were in that conversation. Watch out for a couple of auto stocks. Tata Motors has really revved up. The market is believing what the management is saying about the future. Yeah. Q2 was bad, but management saying for JLR as well as the India business, the second half will be very, very strong. And the market's actually going with that view.
And Sudarshan made this point as well in his top 10 segment. He said the numbers will be weak, but we'll have to see whether or not there's a recovery post that. And that's precisely what's happened. I'll tell you what, we'll slip into a short break, come back. We'll get chatting with the management of Akzo Nobel. Stay with us.
Okay, rounding up close to 9:40, and it's time to get into another corporate conversation. We have the management of Akzo Nobel joining in. The company had actually a pretty decent quarter at a time when biggies like Asian Paints have been sulking under the impact of falling volumes, falling margins. Akzo's performance was actually not that bad. They managed a growth of about 3% at the top line level, and margins were more or less intact as well. Not much pressure over there. We have with us Mr. Rajiv Rajagopal, Chairman and Managing Director at Akzo Nobel, to talk about the performance and the outlook. Mr. Rajagopal, great to have you on. But, you have to allow me this question before we start talking numbers. The entire market wants to know, what is the strategic review of the India business looking like? We've got companies on record. Asian Paints has gone on record to us expressing interest. Berger has gone on record with us saying that, they'd be willing to get into discussions as well. What is the parent saying? And what is the plan for the India business?
So, Surabhi, good morning to you and all your viewers. As far as the strategic review is concerned, what's in public domain is all, to be very honest, even I have as of now, that there is a strategic review of the region that I currently handle, where all options are on the table. At this point of time, the brief that we have is really to run the business, make sure that we continue to outperform. Right. And that's where, me and my management team have really been focused. And I can assure you that, as soon as we have any material information, I would first have to inform my board and all the investors and definitely the medias. But of course, we also need to keep in mind that we have to first also brief our employees. So really no development yet on that. Which is anything material. We continue to perform. As you've seen, the focus has been in the performance in the quarter gone by and even in the quarter that is right in front of us. So we are right now focused on executing our strategies for the year ahead.
Sure. But sir, is there a time frame to this review? What have you heard from the global parent? By when will some decisions be taken? And also, if you could just tell us, in terms of options, you said all options are on the table. So does that include a complete sale of the India business, partial sale, what are the options and what's the time frame?
Surabhi, I wish I know. I mean, to be very honest, right now, since it's a very early stage of the review, the scope, the exact finalities are all being chalked out. As I told you, as soon as we have any material information, we will ensure that we follow the protocols. We are pretty strong in governance, as you know, and we will make sure that everybody in the chain is briefed. It's, in my view, still a little early. I think this will take time. I have seen the commentary again through media of various players, etc. But from my perspective, I'm like a horse with blinkers, focusing and driving the business, because for us, that's really what sort of matters at this point of time.
Okay, let's address that then. Hi, Rajiv. Good morning, and thanks a lot for joining in. But before we get to the operational performance, is there a possibility that instead of selling out, you'll look to buy out some entities?
Nigel, look, I think at this point of time, given the India market cap, buying is, we have to be very careful because, again, we've got to look at not just the historical performances of the companies, but what lies ahead. So really, what we want to see is really how can we take this brand Dulux and all our brands, to a winning position. The reason we are doing this is because, there is, a couple of new players and the market is going to get a bit heated. But this is about saying how can we move this organization and our people to a winning position. I've been sort of in this organization for now more than 12 years. If you look at the performance in the 12 years, we've moved the organization significantly from about 2,400 crores to almost a 4,000 crore company. If you look at our PAC, it was about 150 crores. We are almost now getting close to almost 500 crores. So, but are we happy with what we've achieved? No. The answer is no. I think today, what we want to really do is to really start thinking ahead and planning ahead.
All right, Rajiv, the time you made your big move to AkzoNobel, I made my move to CNBC TV18. So neck to neck on that. But let's talk about business then. What is the volume growth you're looking at for the second half of the year? What does it mean for the whole year? And also in this quarter so far, quantify the price hikes, Q3 average in comparison to Q2 average.
Yeah. So firstly, just a quick one on the quarter gone by. See, look, we hit a double-digit growth, volume growth, but there are two parts that sort of dropped the revenue to where it is. One is the price, because at the beginning of the year, as you've heard from all the other peers, there was almost a 3.5% price correction, actually 4%, but there have been slight price increases in July and August to the extent of 1.5%, 2%. So when you net it, it comes to about 3.5%. And then the mix has been slightly adverse because the growth is largely coming in categories like mass, economy, construction chemicals, and putty. So that's really where the composition is. Not to say that premium is not growing, but the rate of growth of premium is very subdued when you look at the overall average. Now, forecast ahead, look, I would still maintain that our endeavors to continue a double-digit growth across both our paints and coating vertical. And, how is it so far? Look, I think there are a few headwinds still that we saw in the last quarter that is there. But one of the things I must say in the last couple of weeks of Diwali that we really started was a secondary movement was pretty bright, which means that there is some improvement in the market offtake. But still too early. Was it because of the festive? Was it structural? Is something that we need to gauge as we start moving in. By the third week of November, we'll get a good sense on that, Nigel. Yeah. In terms of, the other guidance is, I have always maintained that the industry is going to get a little heated now with new players coming in. And, our guidance has been that we will be in the range that I've always maintained. We endeavor to hold our profitability at this point of time while we continue to focus on growing the business profitably. Our focus is how do we really balance it out between growth and profitability and not really shake one and the other. And that's what really, I must say, the team has done a great job in the last quarter. It is still early days, Nigel. The battle, is just started. So the bugle is just blown. So I think I would like to see how this quarter, next quarter pans across. Of course, by January, the price drops get corrected. So your volume and, your value growths will start coming closer to each other as we move ahead. And we've got very strong plans. We've got very strong plans on our categories, which I can sort of elucidate if you would like me to.
Just some more numbers. Rajiv, hi, Rima here. You said the rate of growth of premium was fairly poor. What was it in the quarter gone by?
So we were flattish. If you look at the previous 2 quarters, we were growing a pretty high single digit. It was a little flattish. This time, actually, for us, the large towns and mass really outperformed. But it's also, remember that mass, we are on a lower base. We only got about a 1.5-2% market share in mass as against almost close to a 15 to 16% market share in premium. So remember that contextually. I also believe that these 2 quarters, not just for us, for the industry, we are hitting some high base. So that also needs to be kept in mind. And we've put some very strong plans in place. Rima, if you look at, we've launched what I call a connoisseur product, Dulux Velvet Touch Eterna. We've also launched Dulux Super Clean 3-in-1 Anti-Scuff, right? So we are focusing on how our brand propositions can be more meaningful. How can we strengthen our brand as we move ahead in our decorative paints? Even our coatings vertical has done well. So if you look at our marine and protective and our powder coating business, we've actually done well. We've added capacity. We've just commissioned our new factory of powder in Gwalior, and hopefully that's just started. So to our customers, particularly in the northern region and eastern region, our powder customers, you would start seeing faster delivery times and hopefully a higher growth as we move ahead.
Sure. So just to wrap this up, you're saying that you'll see double-digit volume growth this year, right? That's the first point that you've made. Just tell us, because you've taken some selective price hikes on an annual basis. What is the margin profile of the business going to be like? I think you're around 14% right? I mean, at a margin level, almost 15% actually. So you'll end the year around these levels. Can it get better margin?
I've always said that 13.5 to 14.5 is the sort of range we will, because you've also got the volatility of the crude and the forex also slightly impacting. We actually got a little impacted by higher raw materials last quarter. So even that range sort of that's what we will ensure that we continuously deliver.
Balancing growth and profitability. Thank you, sir, for joining in. Wish you all the very best, and we look forward to the outcome of the strategic review. Now let's move on and talk about Info Edge. Now, Info Edge has also clocked in a pretty good quarter. There is a recovery in the Naukri business. Billings in Naukri have now hit 14% as IT hiring is showing signs of a pickup. Chintan Thakkar, whole-time director and CFO at Info Edge, is now with us on the show. Mr. Thakkar, thank you for joining in. Let's talk about Naukri business, because your billings growth in the Naukri business was subdued over the last few quarters, and this quarter it's seen a double-digit growth. Can you sustain this kind, and what is happening on the IT hiring front? Has it bottomed out? Are we seeing a pickup?
Yeah, no. So you are very right. Because if you look at last 4 or 5 quarters, we have been kind of gradually growing up. And in my past commentary, we have been saying that, look, I think it looks like that we are out of the U-shaped recovery and we are going on the upside of it, right? And this quarter kind of proves us right in that sense that we are continuing on the path of growth. And more interestingly, it's just not about the headline number that you talked about, but when we slice and dice the numbers and when we look at it, every segment and every sector, whether it's metro cities or tier 2 cities, whether it's IT or it's non-IT, whether it's consultant, large clients, small clients, we look at all this slice and dice, and I think our confidence is kind of much more than what it was when you look at the last year numbers. So we are really hopeful that this trend will continue. And the second part of your question on the IT hiring, yes, we are looking at the IT hiring also kind of gradually coming up. But still, the non-IT is a kind of bit more than what IT is, which in a way is good also for us, that it kind of we have no matter whether it's tech or non-tech, our platform seems to be working very well. But yes, IT hiring is certainly kind of also slightly on the up.
I think non-IT hiring segment grew 20%, while the IT segment grew 12%. Is that correct, Mr. Thakkar?
Yeah, that's
in the quarter gone by. Okay, so for the full year, can we get double-digit billings? Last year it was flattish. So for this year, do you think it's possible?
Yeah, no. If you really look at the past trends and the commentary that I've just given about that it looks like that the things are kind of improving quarter after quarter, then we can really kind of expect that. Look, even if you look at last, let's say 10 years CAGR, we would be recruitment business would be something around at least 15% kind of CAGR. So I think that's the zone in which we have played in the past, and we are hoping that at least we would go. In fact, we would target even more than that, but let's see how it goes. Particularly the last quarter of the year is very, very critical for us. But I must also add here to say that, look, certainly the job market has given a trigger for the growth. But it is just, I think the growth rate is much higher than what the trigger is, and that's because of the superior execution from our sales team, marketing team, product team. I think so. There is a delta, growth that we are getting also because of superior execution that we have. So keeping both the factors in mind, the execution as well as the recovery in the IT market and non-IT kind of continue to go stronger. We would, it would not be unreasonable to expect that.
Unreasonable to get back to the double-digit billings growth that we've historically seen. Historically, it's been 15%, but at least double-digit for this year is not unreasonable to expect now with the recovery in IT and continued strength in non-IT. What percentage of your Naukri revenues comes in from non-IT?
So if you look at direct, from IT is something around, let's look at the consultant, and we divide, because consultant, we don't know who the real customers are, the growth, the IT as well as the non-IT, right? But if you really take it with certain assumption around that, we would think that non-IT should be around, maybe 45%, maybe 50% type of, share in the overall hiring.
Okay. And you want to further increase the contribution of non-IT. So from current 45-50%, you would like to scale it up to what number, sir?
Look, we are at a certain scale that whatever is happening outside in the economy, that gets mirrored on platform. So I think it also depends on what the external reality is, which would get reflected on our platform. Right? But as a strategy, we are, expanding our branches in the tier 2, tier 3 town as well. And that's also getting a kind of an additional delta of growth for us. So we really don't have any percentage in mind. If IT again suddenly starts booming well, maybe IT will again start.
So when will you
has been
expand
continuously has been growing, and it's a reflection of what's happening in the economy.
Yeah, you spoke about the strategic decision taken by the company to expand into tier 2, tier 3 cities also. I think the goal is to hit 100 cities from the current 70. Your presence. When will we hit 100 cities? Is it 1 year, 2 years away, or even longer?
Look, last 15 to 18 months, we have already increased our strength in the tier 2 towns and tier 3 towns. Right now, we will kind of wait for the results to come, and certainly we are seeing some early results in some of those places where we have opened the new branches. But we would wait for it, and then maybe in Q4 and maybe Q1 next year, we would probably look for another round of expansion.
Okay. Mr. Thakur, hi, good listening in to you. Let's also now put the spotlight on the other businesses. Let's talk about 99 Acres. Let's talk about Jeevansathi as well. On 99 Acres, you've done, I believe, revenue of about 102, and the margins is at 17%. The profit before tax, that's still minus 14%. So what is the game plan for 99 Acres in terms of better profitability, and also throw in a word on the Jeevansathi business as well? What about reducing the cash burn and the losses there?
Yeah. So if you look at the billing number and look at the expenses, because revenue is a lag, effect on that, But if you look at that, we are reducing the losses in terms of absolute amount. They are not, really very high. And we are hopeful that by Q4 we will have a run rate of break-even. So it should be a bit neutral by Q4. That's our expectation. But let's see how it goes, and it also depends on how competition is playing as well. Jeevansathi has been, the past 2 quarters has been growing 30% plus. So that's a very encouraging story. Whatever the new strategy that we adopted seems to be working out for us, and that's already almost EBITDA neutral. So that also we think that for the year, unless we change the strategy and start spending more.
No, Mr. Thakur.
Yeah.
Yeah, sorry. Just to clarify, you said break even for 99 Acres in this year. That's at the EBITDA level or the net profit level?
No, at the EBITDA level, there isn't much difference for us, EBITDA and PBT, because there's no real borrowing for us.
So EBITDA break even for 99 Acres in this year by
Q4? The run rate basis in Q4 is something which we would hope for, right?
Yes.
Because in absolute amount, the losses are not very high.
Sure, and for Jeevansathi? Yeah.
it's almost already even even if you look at Q1, Q2, I think this quarter cash basis, I think it's about 1 crore or 2 crore kind of losses. So I think it's negligible. So we are hopeful that even that. So Jeevansathi could be even for a full year, unless, as I said, that we start spending more on the marketing side. We can expect that. So on the current strategy, it should be the case. While 99acre, we hope that by Q4, there are some certain initiatives that we have taken. We hope that it will kind of start producing more results by the Q4 end. So let's see how the Q4 goes for 99acre. But that's the target.
Okay, we'll leave it at that. Thank you very much for joining in. By the way, in the green now for the benchmark indices. The Nifty's recovered a full 150 points from the day's low. Mitesh is now back with us. Mitesh, what have you made of this, and what would the calls be at 10 a.m.?
So, good morning. I was in fact talking about this, that the PCR is extremely oversold, and 24,000 could be an area from where we could bounce back. We got a low right there. We've kind of taken some, not fully but partial long positions on the index, believing that today's low will hold, and there's a good chance that we might see 24,000 and about 250 to begin with on this spot, and possibly in a good case a retest of the highs which the index made on Wednesday last week, which is around 24,450 to about 24,500 zone. So I think those are the targets on the upside. So trading with a marginal long bias, and as long as today's lows don't get taken out, I think we'll maintain this stance.
Okay, Mitesh, before we get to your picks, and good on that call this morning, you said you could look at being adventurous and buying into it. What's the call on Reliance Industries? Because that one's still down close to 100%, and it could be the swing factor for the day, given that HDFC Bank has now stabilized. Call on Reliance and your picks as well.
True, I think Reliance is extremely oversold, but I still haven't got a sign of reversal. Maybe if once we see the stock get past today's high of 1280.82, it should give a corrective rally to about 1300, and beyond that, I think some kind of an up move would start to about 1340, 1350 odd levels. But what is looking strong is the IT patch. I have a buy on HCL Tech with a stop at about 1840 for targets in excess of 1900 here. And the other one which I like is the Tech Mahindra, which I would recommend buying with a stop below 1679 and a target of around 1740.
Okay, thank you very much for that. On your screens are the visuals of the swearing-in ceremony of India's 51st Chief Justice of India, Mr. Sanjeev Khanna. He takes charge from Mr. Chandrachud, who had retired over the weekend. Prestigious post, and Mr. Sanjeev Khanna is now taking his oath. Okay, Mr. Khanna will be succeeding Justice Chandrachud, who retired on Sunday, and his term will last till 13th of May 2025. The President, Ms. Murmu, will be administering the oath of office at the Rashtrapati Bhavan. The national anthem has just been sung. We all stood up here in respect to. That's a big change of guard.
Yeah. So Justice Sanjeev Khanna is the second senior most judge of the Supreme Court. He started his legal journey in 1983. He was with the Delhi Bar Council, and of course, through the many decades in the legal system, now he takes over as the 51st Chief Justice of India. He has had experience and, of course, expertise. His expertise goes into taxation, arbitration, commercial law, environmental law, some of the many aspects which he has looked at very, very closely through his legal career.
Okay, we will slip into a very short break on that note. On the other side, we'll put the focus on commodities. Manisha Gupta will join in next.
Welcome back. So there's been some recovery in the equity market. The markets are well off the lows, and the Nifty has pulled back a whole 100 points. Let's now shift the focus to the commodity markets and find out what's the latest. We have Manisha with us. Manisha, so what's catching your attention this morning?
You know, while most commodities are consolidating, catching their breath, there are a couple of things that have continued to run. One is Bitcoin at all-time highs at above 81,000. And the other is the report that FAO put out over the weekend telling you that the world food prices have surged to the highest level in 18 months in the month of October. If you look at the index numbers itself, it has gained up by 2% on a month-on-month basis. It's up 5.5% on an year-on-year basis as well. And this big jump that we've seen in the food price index globally, much of that really comes in because of the vegetable oil index, which has gained up by 7.3%. It is trading at a 2-year highs. And within vegetable oils itself, we have seen almost everything rally in the global markets there. If you look at the palm oil prices, well, they are trading at 2.5-year highs. Soybean prices, sunflower, rapeseed also are trading at a multi-month highs. The other thing to watch into the index is the cereal prices, which also have surged up by nearly a percentage point on a month-on-month basis. Here as well, when you look at the global cereal production for the year 2024, well, that is projected to decline slightly. It's going to be a second highest on the record even then. But within the space as well, the global wheat prices have surged. That is because of the adverse weather and also because of Russia is now putting up a very strong floor in sense of prices. Maize is also something that has been on the stronger side. It's fuel demand, food demand, also feed demand is what is keeping these prices on the higher side as well. What also has done quite well in the markets is the sugar prices. Brazil lower production and of course the US use within biofuel has been supportive this price. So 2.5% of gains into this one as well on a month-on-month basis. Dairy has been another thing, 1.9% up on a month-on-month basis onto this one as well, and 21% up on year-on-year basis. So these are the food categories within the overall food index which have performed quite on the higher side in sense of prices. I also want to take you to the final slot which tells you on how the prices have been in the last 1 month itself. As you can see, it all belongs to the edible oil price gains. Palm oil prices gained up by 18% in the last 1 month, and you have seen 7 to 10% of gains come in for rapeseed, sunflower. Soybean was up 3% as well. And then apart from that, corn has done well, 5% of jump upon that, and that is when we stop. Everything else in sense of food prices actually have seen a bit of a easing coming in. So whether it's about sugar and cotton, 2% of decline there, 4.5% of cut coming in for rice as India starts to export. And then you have tea prices declining 5%. Cocoa came off by 8% in the previous month as well. And we've seen coffee prices quite flat. For this week now, it really is going to be about a dollar index, which is back around 105. That is something that the street will watch out for. You also have the US inflation numbers coming in this week. And then there is Powell testimony on Thursday. That would give you further directions for this week.
Okay, all right. Got that, Manisha. Thanks very good. Thanks very much. The good news being that there's some cool off in cocoa, tea and coffee. At least is not surging any longer. Thank you for joining in with that. We'll take a quick break on that note, come back on the other side. And actually, before we take a break and get to our next special segment, we have Mangalam joining in. So let's quickly go back and revisit Asian Paints, because while the rest of the market has recovered, Asian Paints, I think, is still under pressure. Let's pull up the stock. Yeah, it'll come up on our screens in just a bit. The color has been red this quarter. Mangalam.
It has been red, and how it's one of the biggest intraday losses that we've seen in Asian Paints, down about 8% when I last checked as well, and for good reason. You know, if you look at the numbers, 5.3% revenue decline that the company's posted. It's lower than every other paint company that has reported so far. We thought, you know, Kansai would be weak, Berger would be weak, AkzoNobel and Indigo Paints were slower, but Asian Paints went ahead and surprised everyone on the downside with a negative revenue growth, and not just a negative revenue growth, a negative volume growth, a decline of 0.5%. Ex-COVID, it's actually one of the first declines that the company's posted in over 12 years or 48 quarters. So that's a negative, and that's percolated all the way down to the bottom line as well, with the margins compressing almost 500 basis points, the net profit falling about 44% as well. What is it that led to the miss? The company attributes that to weak consumer sentiment, persistent rains and floods in some part of the country. Also, the international business was impacted by weakness in Ethiopia and Bangladesh. The net profit was impacted by a couple of exceptionals, 124 crore impairment of investment in Whiteco and 56 crore forex loss in Ethiopia. The important thing to track, however, how much of that perhaps could be competition? Because if you look at the management commentary, you know, the company has alluded to increased rebates and increased sales expenses twice. Does that mean that they are giving a lot more to dealers to push their product and that's impacting their overall margins? That is something we'll have to watch out for. Employee expenses too, as a percentage of sales, have increased by 13.5%. As a proportion of sales are up by almost 140 basis points. That's impacting their margins as well. So when you pay a little more margin to dealers and a little more to your employees, Is that because of competition? That's something we'll watch out for. The company is expecting margins to recover, but demand conditions are still a little, subdued. The stock, with today's decline, has gone back to May 2021 levels. It's fallen almost 30% from its 52-week high, trading at around 45 times. The two key questions that everyone will want to know the answer to. One, will things recover for Asian Paints from here on? Or second, is there room for further derating after this big decline?
Well, the heightened competition, perhaps there are no easy, clear answers immediately, which is why that stock is still down 8%. Maglam, thank you very much for that. We'll take a break. On the other side, our special segment, It's the Economy, coming up. Lata today will be in conversation with S&P Global Ratings, as well as experts from Goldman Sachs to talk about the underwhelming Chinese stimulus package announcement.